Hello everybody, my name is Alexander Shemetev. It's very nice to meet you, and I am happy to introduce my topic from today. It's devoted to very unusual topic. From one side it's devoted to the crisis. Sometimes there could be times of the crisis where special needs or special financial actions are needed from certain people or companies. On the other hand, we will speak also about calm time, comfortable time, and we will speak about the contrast about this. Our primary field we are talking about is finance, of course, and we will try to estimate a very specific model, classical model. It's Fama French model. It's the next step from the sharp model. I would not say that Fama French is much better and that it should be always used, but when you have data sufficient with sharp and Fama French model is never worse than classical sharp's model that is used for decision making because of its simplicity. At the same time, Fama French model is more complicated, and there is not just one factor taken into the account, but 6 factor. It's capital size. It's very many different factors, momentum factor, for example, and all the factors that Fama French Institute considered as important ones, they are estimated and counted in this model. So we will speak about this, and we'll try to say what is the best way for investing in these times. So let us start. Our topic is mutual funds. Mutual funds, it's a very common thing in the United States of America, for example. It's something usual. Many people try to invest to the mutual funds. There is a number of quite famous mutual funds, like for example Vanguard or many others that have very good reputation, and people can always invest in these funds and earn some money, which always is good. So what's a mutual fund? It's when people like you gather money and give them to fund, and this fund it actually tries to find the best implementation for money, for your assets. Some funds try to replicate the market, so you have the market return with the maximum probability. Some funds they try to get you extra money. So in times of the crisis or in times of the stable times, and some funds can have less income in normal times, but you will have less loss in crisis times. So that is how these funds are actually made. So let's start to say Fama French, these are 2 inventors of this model. They both actually had a Nobel Prize in economics, and they won it and they deserved it, and they created a wonderful model we are trying to speak about today. And let's take quite a big interval in time to speak about. Let's take 40 years. 40 years, it's quite a big time. It's sufficient time in order to make quite profound analysis. So what was actually done? We took data, usually it's a daily basis with some interruptions due to objective reasons, and we estimated them on trends. Then we run regressions on this data, and due to these regressions we could say which fund is the best over the last 40 years. So let's concentrate upon the last 20 years and let's speak what could be the best fund. Today, coming to financial markets, you can see buy our fund, it's the best. It looks like in some supermarket where you go for some commodities and you see commodities and quite seeing this, so maybe I should take this one thing or maybe that one thing or something like this. And that's actually how it works, and you are the purchaser, you are an investor. You can choose what you like the best, pick it up and of course you're trying to take it from something like discount price, yeah, something cheaper than actually the market price, in order to be capable to, for example, to sell it at more expensive price when it will be appreciated by the market. But there is one thing, that market actually appreciates commodities quite well in normal times, but there are also crisis times. Crisis times may give you something like an opportunity to earn some additional income. It's not always so, because crisis is some instability. It's something where it is hard to predict, like something with some confidence or something like this, and financial markets are quite competitive. So it means that information taken, it's analyzed not just by you, but by quite a number of investors, and you could make a good decision. So let's discuss the results of this analysis. What could be like the best fund? Okay, crisis times, best funds. So let us start. What could be the best one? So let's recall the analysis of the crisis. It's not sufficient to analyze any fund just in times of the crisis. It's just like what was done. Let's say about this a bit. So first we analyzed the fund within the crisis time limit, like this, 5 years within the crisis, making different cuts within it. Then we analyzed 5 years before the crisis and 5 years after the crisis in this direction, yeah, this and this. So our analysis interval, it's like 15 years. 5 years, it's like it is taken where the crisis is, somewhere in the middle. Yeah, there is a crisis before and after a short time. Then plus 5 years to this interval on the one hand, and minus 5 years on the other hand. So that's how it was actually analyzed in order to the prediction to be stable. So how to analyze good funds? There are many strategies how to use different models for this. Let's speak about the Fama French. I would recommend maybe to look at the alphas, so like the alpha 0, which means you have like a higher regression coefficient like this. You could see the significance of the alpha for each fund, and if alpha is high, it means that the model, in order to be best fit, has to make higher intercept than the market return. So this means that highest alpha can give you higher opportunity to earn from your investments to the market, and this means that we could use this approach in order to estimate the funds. Our purpose is to call and to name the best funds. It doesn't mean that other funds are bad or something like this, no. It means just we pick up the best fund that could be in crisis time, for like the last crisis that actually came, and we'll try to discuss the results. So let us start. The first one crisis, it was like 2001 crisis. It was 9/11, as you remember, and it was not an easy time. Of course, financial markets, it actually replicated like quite many things, like from this crisis. There were something like expectations that this crisis could be like complicated, complex, and very much unusual. Financial markets, they reacted to this crisis. So what was the best fund? Let's say that there was like no stable investment decisions in this time. So we found like only the risky fund with highest alpha plus 0.82%. This is the SCFX fund. So you can find this abbreviature like on Yahoo Finance or something like this. So that was the fund with the highest alpha. At the same time, this alpha was not very much significant from the regression coefficients, which means that it's risky. So you can take some higher income from this fund, but it's very risky investment. But in times of the crisis, maybe it could be something that you're looking for, something that maybe could be good to invest in 2001. Let's speak about the next crisis from our recent history, financial crisis of 2008. So what was this? It was a crisis, very unusual crisis, and there were quite many interesting things about this crisis. We will not discuss them all here, because it's not our main purpose, but let's try to discuss the best funds that performed the best in this crisis. So there was an opportunity to separate all the funds into two categories. One of them is for risky investors, another one for more stable investors. If you're risky investors, you can earn some extra money. At the same time, you take higher risks for this. So you accept the risk. You should be like risk-loving person, and this can give you additional extra income. So what was the highest alpha for the risky investors? It was VEVFX fund. So it has some significance, so it has 10% significance, this alpha. It could give you additional 0.94% in this crisis, which is quite high additionally to the market, but it's quite risky, you should know it. From the other hand, in 2008 there was another fund that performed quite well. Its alpha was higher than the average from the market, and it was significant. It's very important that regression alpha was very significant, on 99% significance. So what was this? It was VWINX fund, which would give you 0.65% additional to the market. So investing to this fund can actually give you extra money if you would return back to 2008 and invest your money. So if it could be possible. Let's say about the recent financial crisis. It's 2020. It's maybe not very happy year for the planet, because quite many events happened, and the most terrible event, it's coronavirus, the COVID crisis, and it's quite clear that there is the beginning of the crisis time. Is there any fund that could perform good in this time? So our regression analysis show that there is no no stable decision for investors. So there is only one fund that had quite high alpha, but it's insignificant, which means that in this time it's a very risky investment. So our regression revealed that there is a fund called VWINX, which actually is quite risky. At the same time, it gives the highest income. So if you're a risk-loving person, so this could actually help. As you can see, the effectiveness and the efficiency of the model, for example, Fama French model, it actually we can say that for a private investor, it becomes less and less clear where to invest using this model. Why? Because the model becomes more and more popular, more and more widespread, more and more people use it, more and more people accept these financial decisions, including based on this model. And this of course is one of the reasons why, if you are using this model, you could expect that something can go on not as you expected. Just because there are quite a number of smart guys who are actually doing the same as you now, trying to earn money and trying to use this model. So, but it doesn't mean that you should trying to find any more complicated solutions, maybe, but at the same time don't underestimate classical models. So that's what you should know. It's quite a good way to know that investing is quite an interesting thing, and Fama French model only wants you to run regressions. It doesn't mean you should invest in mutual funds or you should follow the advices. It's just what I had. For example, for this analysis we just picked up just several mutual funds, about 12, and compared them with each other, which is the best one. So it's just in order to show you that this model could be used in times of the crisis. It's quite useful you shouldn't underestimate it, but you shouldn't like rely solely on this model. So if you're of course an investor in this time. So that was like the topic of my speech today. I hope it will be useful for you, and if you have any questions, so you may ask me at the end of this event, and I will post this video, and there will be like an opportunity to send me a question through the moderators, for example. Yeah. So thank you very much for listening, thank you very much for your attention. I wish you a very nice day, and goodbye. Thank you.